Folks, sometimes it's hard to tell if I'm live or not, but I think it's going first and foremost. My name's Eric Wilkinson. This is Pro Trader Strategies and our weekly webinar on different types of strategies we can implement around any given assumption. Right now, what we're doing is the pops and drops. Sometimes we just don't know if the market's going to go up or down. We just don't know the direction, but we have a pretty good feeling that it's going to make a move. I've talked about this in the past with some of my crude oil trades last week when we were talking about it with the strangle. Now we're getting a little bit more aggressive with the straddle. It's a little bit more expensive, but at the end of the day, the probabilities are much better for this type of move. So you got to lay out a little bit more money in order to get those probabilities moving in your favor. That's a risk reward and all of those things that we tie together with options. If you aren't paying very much, the probabilities are very small, all right? So the more you're paying, the probabilities are generally much better that you will at least finish in the money with some of these options. With this strategy, you're almost guaranteed to have an in the money strategy or option. And we'll talk about that as we go along. But before you guys go, make sure you guys subscribe and hit the bell, because that bell will give you a notification when I pop in unannounced. Yeah, this is scheduled and I pretty much hit it right on the nose with the timing, but I do spot the trade videos, and those are where I talk about different option strategies I find to put into my portfolio. And what I use those as is real life examples for you folks as we go through this process together with these strategies. I show you when, where, and how to actually implement those in real life, hopefully at the moment. I'm trying to time those as closely as I can to at the moment for you. So make sure you're subscribing and hitting that bell, because that's what gives you guys that notification. And finally, throughout this video, if you have a comment, throw it over there. If you have a question, please put it out there, because I do have a tendency to misspeak sometimes. I get a little ahead of myself trying to read and do all these other things. So I'm not perfect. So if you see me misspeak, throw it out there. Throw me under the bus. Make sure you keep me on track if you think I've said something wrong. And if you have a question, somebody else, folks, has probably got that same question. All right. So without further ado, we're doing swing trades. I'll talk a little bit about swing trades. I'm going to touch on how to trade around momentum shifts. And that's really all a swing trade really is. And then we're going to narrow that down to the best option strategy for that given assumption. A pop or drop might not necessarily always fall on the straddle, all right? And therefore, we might want to go to the strangle or a butterfly in some regards, okay? We've done the butterflies not too long ago, so if you are curious about those are a different beast altogether. All right, so swing trades. First, we're going to talk about swing trades, and then I'll roll into, once we find our assumption using the swing trade process, then we'll narrow that down how we find that option strategy, okay? All right, long straddle. Yes, we are going to ultimately find the long straddle, but I know, again, you folks don't come into any given day and say, hey, you know what, maybe a long straddle is something that I should throw on today, and I'm not sharing my screen. Sorry, folks. There we go. The long straddle, swing trades with the long straddle, but I'm going to put that long straddle on that shelf for right now, because I really want to talk about the swing trades and how we come to that strategy. All right. So first off, what is a swing trade? A swing trade really is just trying to find different momentum shifts. And I'm sorry, I have had a bit of a rough week with some sinus issues. If you guys have been watching the daily market commentaries, you guys know very well I've been sneezing like sometimes. So, but ultimately, so bear with me if that starts happening. We're looking for trying to find an overall trend in the market, and we usually are looking for bullish, bearish, or bearish and market neutral. Okay. And then we kind of look at how the market is moving around this overall trend, and we'll kind of see it, do things like this, right? And, on the flip side, we could see something go like that on the neutral basis. And of course, we have our bearish, right? Then you kind of squint your eyes and figure out where it loses its strength or its momentum to the upside, and just draw a line in there. And then find that support where try and hit the most bottoms as you can, all right? Maybe let a couple of them peel through, but try and hit as many of those as you can. And then that's basically, we start finding our support and resistances. In this case, I'd probably go a little bit higher than that first one, but maybe clip off a couple of the other ones and try and hit as many as I can again and again, something like that. All right. And then after we've determined the overall trend, we've kind of found our support and resistances. Then over time, it doesn't always happen just today, but then you look for the opportunity of that momentum shift, right? So this would then be a bull trend with a bull pattern happening, right? And here is another bull pattern. So we're going to base our trade off of what we decide the pattern is here, and this one being a bear, right? So we'll try and do that. Obviously, we're talking about one that is a pop or drop, and what I usually look for in something like that is it could be in a bull, bear, or market neutral trend. I'll just give an example of a market neutral trend where it's going like this, and then we'll see it kind of do this. That's when I'm like, all right, we've got our resistance, our support areas, and it's kind of right there at the middle, right? Now, I don't know if it's going to shoot to the upside or the downside. You can come up with your thesis however you do. I was talking about one of these last week. I've got a new example this week, but last week we were talking about crude oil inventories. Somebody's saying it's going to go to 100. I'm saying that there's just not the demand there, and it's going to drop back down into the 70s or 60s for crude oil. Well, that's a pop or drop scenario, right? Then I had to go in and determine what was the best strategy for that given assumption. And we talked about that last week for the strangle. So please go back to that one. But this is very similar. We're looking for something where we're going to look for a pop or a drop. And then ultimately you look to cover this trade when you hit the outside support or resistance there. Okay, that's where you're going to key on covering this trade. We were talking about getting involved on the momentum shift here, and then we're looking to get out somewhere up against that resistance area. I also talked about for lower risk tolerant folks or newer traders to get out right there at around that midline. Now we're kind of looking at this midline where we've kind of settled down, and I'm expecting more of a pop or drop scenario to happen. I don't really have a discernible direction, if that's makes sense there. All right, again, here we go. If we go to from simple concepts to real life examples, which is what I'm trying to do here for you folks. We've talked about the simple concepts. Now let's go to real life examples. We've got an overall bull trend. We can see that. I've drawn in resistance and some supports. If you are more of an aggressive trader, you might be looking at something like this as your resistance area for this particular underlying, okay? And maybe a support's a little bit more aggressive, all right? So I am looking for, in swing trades, I like to look at the candles. So something for you folks, if you want to start having something to key on, this is real. They have all kinds of crazy names for these candles and the combinations of candles and everything else. Ultimately, it comes down to a few simple candles, mutually exclusive when I'm writing these. I'm not trying to create a pattern like you see somewhere down here. What I'm trying to do is show you different examples to look for. But we can look for a doji like this, which is basically a hammer doji. They call it a spinning top doji when it's got a little bit of a wick down there. A hangman doji when you've got it at the top there. You can also have it flipped where it's got a little bit of the wick at the top. And another one is the tombstone. All right. Now, keep in mind, those are mutually exclusive on this. And we aren't talking about these are called the setup candles. This is the ones where all of a sudden, okay, now it sends off that light bulb in my head that I need to start paying attention. Aggressive traders will trade on the setup candle. I would implore anybody that's newer to trading around these type of candles, wait for the confirmation. And if you have a lower risk tolerant type of personality, then also wait for that confirmation. If you're very aggressive, used to trading, used to risking money, all of that stuff, you don't actually any longer correlate your trades to money. That's when I think that you've gotten over that hump. That's when you can actually start considering yourself a real trader, folks, is once you've gone from thinking about, all right, I need to make this much money on this trade, or I want to make this much money on this trade, I can't lose this much money on this trade. Those are things that will drive you to going broke, basically, because you're going to be constantly second guessing yourself. You're going to be worried about it. You're going to be emotionally tied to this trade. And what I want you to understand is I'm trying to get you folks to a place where you think about all of this stuff mechanically. Okay. It's probabilities, mechanical, how we go through this process. Okay. That takes the emotion out of it. But something I did want to say is all of these candles could be green as well and look very much the same. Okay. Mutually exclusive again, but you know, candles looking very similar, and even the tombstone. Okay. So what I was looking at on this trade is we've got one of those red candles that I was talking about. And then right next to it, it's got confirmation. So we've got a real long candle there that I kind of pointed to. And then it's got a bit of a base kind of like that. Now that is a bottoming pattern. That would be very much in line with like a setup that we would look for a reversal, because it's at the bottom of this move. And then the next day, confirmation. How do you figure out confirmation? It's got to close above the top of that wick there. Sorry, folks. Didn't turn off my thing. So it's got to close above the top of that for a real confirmation. And that's what happened here. So that would be something like on a bullish move that you would be looking for in this example. On the confirmation here, that candle is at the top of a move, again signaling in this regard, losing momentum to the upside because of that candle. You know, you can see it a couple other times. There's a similar candle. It's green. Not so much here on that one. Not a very good example, but you can see another example there, a good example there as well. So not so much there, but you can get the green confirmations next to it there. A good one here, you know. So look for those at the tops and bottoms of the move. If they are like in here somewhere, that doesn't tell me anything. That's inside of the major overall major overall trend within the middle of that pattern, if you will. So an aggressive trader might put on a bearish trade here, and depending on what that is, if it had low volatility, you know, if you guys have been following along all of these courses, you know, low volatility, we are looking to buy. If it had high volatility, we would be looking to sell premium, and on a bearish setup, that would be selling calls. And as an example in this one, we've been playing IBM forever. I actually talk about this in the Spot the Trade videos. I've been trading IBM since the late 80s, okay? And IBM, you know what I was trading then? $100, folks. It really hasn't gone anywhere. So if you're looking for a neutral type of underlying, that is IBM. And you can play this all day long, especially if you own it in your portfolio. You should be playing this. That's how I got trading options, is I had IBM in my portfolio and Walmart in my portfolio. IBM traded around 100, Walmart 50. And I was trading short calls against it, get called away, sell some puts. Now, that's not necessarily what I want you to do these days, because it costs too much for those assignment fees and stuff compared to just trading. But I've been trading IBM forever, and it always trades right around 100. Even if it blasts off to 150, you kind of know it's coming back to 100. But in this case, what we were looking at is we were selling some calls up here at like the 140 handle, well above where this underlying was trading, and outside of even those resistance areas. That's what I'm talking about with options is, you know, you saw me talking about those short calls up there at that 140 area. Well, I'm collecting a credit up there, and that's above two other resistance areas there. All right. Now for this one, we've got the bearish overall market with the support and resistance there. So we've got this bearish overall trend, right? We could try and draw some lines in here to try and capture the support and resistances there. All right. So something along those lines. I'd like to have straight lines, but I don't have those here. Sorry. So anyway, coming down here, this was something I was keying in on for a reversal of that pattern reversal there. But sometimes it doesn't work out. We'll see something like this where I'm like, oh yeah, we've got that. But boom, next day, what happens? We do not get that confirmation. That was the next day. We can see that green candle erases the setup candle. Okay, so that's how, when you're trading these things, if you got aggressive and got in on that candle, you would want to get out when it looked like it was settling above that setup candle. Okay, that breaks the overall pattern. So this broke the pattern, but I had gotten short some calls up here, like I mentioned before. Yes, it came up. Excuse me. It came up and tested this fib, broke through it. I'm not going to lie, this trade was losing money. It's directionally against me. I sold these calls because it had high volatility. The volatility kind of hung in here. So this trade was working against me, but I stayed with it, and I ended up waiting for another confirmation on that top trade. I knew I was pretty free and clear now once it started rolling over like that. So we were able to stay in that trade a little bit longer than if, say, for instance, you went out there and got short this underlying. Can you imagine how painful that move would have been? It would have been, you would have been pulling the ripcord, and then by the time you pulled that ripcord, you would have saw it like roll right back over and just been like, why am I doing this? So with calls, you can get up there. You can keep your powder dry. You know it's going to work itself out. Again here, SPY, it's basically a green candle that isn't necessarily confirmed at this point, but we could see that this is basically a doji that looks like that, which is very similar. Anytime you can get those looking like that, it is pretty much the same idea. And then what happens? By the end of the day, that whole candle got totally erased and free fell. Took some heat on that. But again, we had high implied volatility here. We were selling puts down here at the 415 area. I was selling puts and collecting a credit for that, knowing full well if the underlying came down here, you guys hear me talk about this point of control where that is the acceptance of value. That's where the market perceives value. Well, if the market perceives value at that price, then doesn't seem like a bad price to be getting involved in, right? Good strike location. You can create the strike location where everybody else thinks value is. And if it never gets back down there, then I just get to keep that money. So in this case, again, directional move against me, and we were able to pull out of this. And I talk about all of those trades that I was just mentioning in my spotting the trades, where we go through real life examples on a daily basis. So if you want to participate in that, make sure you not only subscribe, there's a little bell there that almost nobody hits, and click that so that you will get a notification when I pop in unannounced for those morning spot the trade videos. All right. And if you guys had any takeaways, please smash that like button for me. What it does is it feeds these little bots that goes out there and finds somebody that to share this information with, just like you. All right. A little bit of review. How to swing trade. We spot that overall trend, right? Is it bullish, bearish, or market neutral, right? That's what we're looking for there. Sorry. Now you got somebody ringing the doorbell. And then we need to find those support and resistances, right? Because we're looking at what the underlying is doing. Find those support and resistances. All right. And then we're going to try and find the pattern within that, whether it's bullish, bearish, market neutral. That's what we're going to set our trade up on. But why do we want to use options, folks? Well, the reason why, you have better probabilities, all right, or better odds. I'm going to just say odds because I don't want to write out probabilities. Better odds. You also have your risk reward most times. I mean, if you're doing naked, then obviously that's a little bit of a different beast. But for the most part, especially with this strategy, we are. And you are going to have less risk, believe it or not. Why? Because, for instance, if I'm buying an option based on a move, my risk is the amount I paid for that option. If I'm out there buying the underlying stock or ETF outright, that means my risk is dollar for dollar in those moves. We can use options, and our odds are what we laid out for this money, so we know our risk going into it. And in this case, we would know our reward is unlimited. And most cases, when you're trading stock, you don't always know what your risk is. You have a pretty good idea your reward is unlimited, especially if you're going from the long or it goes to zero, right? You're also going to have lower margins. Think about it. If I'm buying a stock, that's, say, sorry guys, I got a tickle in my throat that's driving me crazy. If I've got a stock that's trading around $50 and I buy 100 of those stock, right? Buy 100 stock. The brokerage companies are probably going to make you put up 50% or $2,500. With this strategy, it's less than that. It's almost half, really. So you can see that the amount of money you have to outlay for this strategy in particular is much less than if I went out there and was trading the underlying. Sorry, guys. I think I got it. Bear with me, please. All right, so lower margins, you know your risk, and you're going to have better probabilities. All right, in this case, I think I talked about this. We were selling some calls up there. This was, well, I got a little ahead of myself, but this is where I was saying, when we got set up on this trade here, it was selling calls up here at around the 140 area. All right, so great strike location because I'm able to get to a place where we haven't even seen traded in the last 52 weeks. And you probably know, if you've had any exposure to trading at all, you know that when they make those new massive highs, kind of has a tendency to at least pull back when they're new prints, because everybody and their brother is thinking, oh my God, I've never seen this print. I got to sell. The last time it got even close to this, I thought it was blasting off, and I didn't. So now I'm selling. So that's what happens. And it happens time and time again. So it starts reverting back. As a matter of fact, in a trade like this, I think I can probably show you IBM as a more updated screenshot here. And look at this. After their earnings, they're right back down to this area that we could even drop back for 10 years and it'll probably still look the same. But for the most part, anytime it gets above 150, it is not going to last. And for the most part, it wants to stay within from 136 to 116. That's exactly where it's been ever since I can remember. So again, back into this trend channel that is neutral. So opportunity in IBM. Now, I don't have anything in IBM right now. I'm just talking about how IBM is a neutral pattern for the most part since time's begun. And again, in this case, when we were looking at this trade, I got again ahead of myself. We were selling puts down here at the 415 area according to my guidelines, so it wasn't breaking any rules there. And that strike location just so happened to be right there. Well, I picked that strike location a little bit because of that point of control, but also knowing that that's where value is set. That's exactly where I would want to be getting long, and selling puts, we'll learn, is where you are willing to get long. So let's go to a real life example here, similar to what I was talking about. Now, Penn has had a massive run up during the pandemic. I mean, Portnoy put Penn on the map, to be quite honest. And now they're opening up all of these online gamings everywhere. Like, for instance, here in Arizona, there was no online gaming for sports betting. It was for the casinos. Now that's all opened up, and all my friends are talking about it now. So I would rather have my odds placed on trading here than placed it with a bookie. So I don't get into that, but I hear everybody talking. I pay attention. So nice massive move up there, but something to note, this, I took off all of the other stuff. They do have an earnings coming up. We can see that they're trading a bit sideways here after, this basically was a pandemic low. And I've talked about this. I've lowered my cost basis in PEN on the stocks that I own to zero. So, you could use this strategy around an underlying you own. It'll help you to the downside. You can take advantage of any type of move to the upside. That's not why I put this trade on around this. I'm looking for the pop or drop. So with that said, I can see that it's getting tighter. You can see the big moves are starting to wind up. I like to relate it to the balsa wood airplanes where you crank up the propeller, and the more you crank it up, the more energy builds up inside that rubber band, and then you let it go, it's going to spin faster, right? Well, same idea as here. The longer it gets wound up and tighter it goes, it's going to want to pop or drop in one direction once the buying or the selling pressure ebbs. And we don't know what that is at this point. So for me, I'm looking for a pop or drop type of scenario with PEN. But before we can implement an option strategy, we got to kind of understand these little things that we're playing around with. And there's only two option types, folks. We can combine them and build all kinds of crazy strategies from just two option types, the call and the put. All right, that's it. A call and a put is all we have. But the call, if you are looking at it from the buyer's perspective, the call buyer, because he is paying out something, has the right but not the obligation to fulfill the contract. All right, so the buyer wants the right to buy the stock. So let's do a simple concept here and just wrap your mind around it if you're newer to trading. Let's think about this. If XYZ is a stock and it's trading 100, it could be an ETF, I don't care. And I buy calls up here at the 105 strike. These are calls. I buy the 105 call. All right. That gives me the right but not the obligation. I pay $1 or something. I pay some kind of fee for it. I get the right but not the obligation to buy the stock. XYZ is still trading 100. Do I want to go through the assignment process? Meaning, do I want to exercise my right to buy XYZ at 105 when it's trading 100? No. Nobody in their right mind would do that, right? One thing we do know, though, when options go in the money, like for instance, this is out of the money option right here. It's out of the money because it's a call that is above, right? Out of the money means nobody in the right mind would go through this exercise process. Is another way you can think of it. You're out of the mind to do it. So, but if this underlying shoots up and is now trading 195, I just said this has to include the benefit because it's in the money. It's worth something. And it has to include the benefit. And that benefit is from 105 to 95, right? So $90. It has to at least be worth $90 because it's including the benefit. If I exercise my right at 105, it would go into my portfolio at 105 and it would show my P&L is up $90. Okay? That's if you exercised your right to go through this. Now, I implore you not to do that because there's this thing called theta and volatility, and that adds into the premiums, and we'll go into that a little bit further here in a moment. But I want you to know that not only is there $90 here, there's probably a couple extra dollars in there also. And if you've ever walked down the street and just walked past the dollar, well, I'd call you a liar probably. Everybody would pick up that dollar. But you got to also remember with options, for every one contract I do, that's equivalent to 100 of that underlying, all right? So one contract is kind of like an ETF in a sense where it's got 100 XYZ stocks in it, all right? So every time you're looking at the options and they say it's $1, well, just know then you got to multiply it by 100 because of the option contract multiplier, meaning there's 100 of those underlyings in that option. Does that make sense to everybody? I don't want to blow anybody's mind there. So if I do, or I misspoke, throw it over there in the comment section, guys. Come on now. So, if there's $2 in theta or $2 in volatility in this as well, that's an extra $200. Now, you don't want to leave that laying on the street, do you? No, nobody would leave a $100 bill laying on the street. Nobody. I don't even think Warren Buffett would or Elon Musk. So don't go through the assignment process because you would lose that $2 and you would pay $35 to do the assignment process. Better to offset the options for that dollar, which is really $1 or $2, and go out there and buy the stock, which is free now. So you're saving yourself about $235 altogether, $2 for the theta and $35 in this example for the assignment. You can see where that whole paradigm shifts in that. Oh, you got in late? All right. You got the notification. Just got in. First time got in late. I hope you got the notifications. Maybe you got those late too. All right. So the call buyer has the right but not the obligation to fulfill the contract. Why does he have that right? Because he paid out money for it. All right. Now, the seller, the person who collects it, kind of like your insurance company, right? You pay out premiums all the time, right? Well, the call seller is like that insurance company. He's selling you that contract, collecting a premium, but for collection of that premium, then he has to deliver the stock at the agreed upon contract price, which is whatever the strike is. So in this case, I would have to deliver, if I sold him the calls, my stock at 105. And if I don't own that stock, then I have to borrow it. All right. So you have to somehow give him the stock because you got to fulfill the contract. Now, if you're a put buyer, that gives you the right, but not the obligation to sell your stock. All right. Now, remember, the reason why you have that right is because you paid something for that contract. Now, in this case, if I bought similar, let's say I bought the 95 puts, all right? Now, if I buy the 95 puts, that gives me the right to sell XYZ at 95. If it's trading 100, who wants to sell it at 95? No, nobody. No, there's no value in it. Yes, you did have to pay for something for this contract, but that's on the expectation of future value, the expectation that it will become valuable by going in the money, okay? You could also do it to hedge your stock, and I don't, that's not really a practice I like to do. And I talked about that all the time in the daily market commentaries for the most part. But if this underlying went to zero, right, what then happens to my puts? Well, they're at least worth $95, right? Because I'm able to sell my stock at 95 and buy it back for zero. So this put has to at least be worth the intrinsic value of that option, which means the benefit, okay? Whatever it is from my in the money option to where it's currently trading on the put side is my value at least, okay? It can't be any less than that, all right? It can be more. It can't be less. It can be more. Why? Because of theta and volatility. It can't be less because it has to at least be worth the benefit of owning that underlying or that option. And then the seller of the put has the obligation to take delivery. I mean, I'll buy your stock at that price even if it's trading zero. I get to collect. I get to keep whatever collection that we agreed on when we signed that contract together or entered that contract together, but that's all I get to keep there. All right. That is your max profit anytime you're selling an option. that collection of credit. All right. So let's put all this together. Options prices, we've talked about this, right? We talked about the fact that if you are a buyer, you have to pay something out for this. And if you're a seller, you collect something. So there is a medium of exchange there. And I also mentioned in the option montage, keep in mind, these option prices are in dollar denominated terms. But there's an option contract multiplier in there of 100 because each contract in here, each strike is assumed to have 100 of the underlying in it. It does. You would get 100. You will never get 99, right? You will get 100. You will never get 101, right? So that means the strikes are associated. So you can pick any strike along the option montage. This is the montage page. If you ever hear me say montage, this is what I'm talking about. Oh, he got the notification, but he was running late. All right, so it's working. The bell's working. Good to hear. All right, so now what I want to do is I'm looking at pen because this was my example I was looking at earlier, right? We're looking at an example for pen. I need to know if these prices are expensive or cheap. Why? Because we're buying and selling options, right? I want to buy cheap and sell expensive. I would never want to buy expensive because they can become cheap, even if the underlying doesn't do anything. I can easily see this money just fly out of my pocket. So what we need to do is find this option montage page, and you need to know the Greeks, all right? Don't run away. I've got easy ways for you folks to remember the Greeks. Vega is just volatility, all right? And more specifically, it's implied volatility, all right? Now, you'll see implied volatility in a lot more places than you will on the option montage page. Very few places will it show up here. Why? Because they just renamed it Vega to confuse everybody. I don't know why. This is the calls, the puts. We have Vega for all our options. Now, I'm going to briefly go over the Greeks here, all right? Don't run away because I think this is going to be one of those things where the light bulb goes off and you feel like you need to smash that like button for me. All right, Vega is just volatility, the V and the V, all right? Now, all of the options are assuming that we are advancing. We're moving forward, all right? And for that, delta is telling us for every dollar move higher in the underlying, our premiums will adjust by that corresponding coefficient. So in the calls, we can see it's positive. The puts, it's negative. So as the underlying moves higher, those puts become less valuable, okay? Vega is 1 percentage move higher. So an increase of 1 percentage point is what this rule is talking about. So let's go to here and say 56. So that means it goes from 56 to 57.23, right? 1 percentage point increase. We would see that all of the corresponding values here for Vega will add in to those premiums, even without the underlying moving a penny. All right, 1 percentage point move higher. All of the premiums on the calls and the puts will go in to those premiums by 7 cents. 2 percentage points is 14 cents, right? Pretty simple concept. So we could see all of those premiums go in there, and vice versa. If the premium starts, or if this number starts going down to 55.23, then a negative plus a positive makes it a negative. Okay, just like over here, if underlying started moving down $1, well, a negative plus a positive makes that a positive, right? A negative plus a positive makes that a negative over there on the call side. If you go back in time, well, theta is just time. So delta and theta is time. And notice that theta is always negative, right? No matter where you are, it's negative. Why? Because theta is the thief in the night that comes and steals your premiums, all right? So you can't stop that unless you go back in time. And as far as I know, we can't go back in time just yet. So always a negative to the premiums. Every day that goes by, the corresponding theta comes out of the premiums. All right. So you could see that they could even offset, right? If volatility went up and theta went down, they could be offsetting one another. All right. That's what we're trying to do here at Pro Trader Strategies, is teach you folks how to turn the probabilities in your favor. Like, start thinking about this logically and how you want things to happen. So I want to know what this number is. Is it high or low? We can't tell by just looking at it. And I can't tell if 56 is high or low by looking at Tesla's or even somebody in their space, like another casino. No, because every underlying has its own volatility coefficient, basically, and where it's going to stay in a trend. So what we need to do is we have to chart this and figure out if it's high or low. So you can see down here, I have an implied volatility chart with toss, think or swim. So this is one of the most important things I have ever found in order to determine option pricing, right? They're going to give you numbers all day long. What we have to do is use our brains and figure out if those prices are cheap. Well, if I'm looking down here at where it is currently and where it has been in the past, just by looking at this, you could say that those premiums in that option montage are pretty darn cheap, at least for the last year. And even if you take out all of this craziness that happened during the pandemic, right, which is what I do, I'm taking that out because that was a black swan event. And as a trader, we know black swan events are something that very rarely, if ever, happen. The last time we saw those volatility spikes like we saw during the pandemic was 1984. All right. I skipped .com. I skipped the flash crash. I skipped the financial crisis. All right. All of that did not equate to the volatility we saw during the pandemic. Last time we saw that volatility was back in the 80s. So that's why I don't want to really take that into my data set. The volatility is too high. So I want to take it from basically the last 6 months. And even so, I can still see that that volatility is really low for the last 6 months, just as a ballpark. So just by glancing at this, I know I can look back over there in that option montage page and say, these premiums are cheap. And somebody might be like, well, how do you know they're cheap? Well, because if I go over here and I just look at implied volatility, I can see, look how low it is, right? So let's zoom in on it. Now, I have the code or the script that you can put in your watch list for Thinkorswim to narrow it down to the last 6 months. Because like I said, I do not think we're going to see that kind of volatility again. It was just way too unknown. So I'm trying to discount everything that happened before that. And I didn't get my line very good, but close enough for government work right now. Again, though, you know, you can still see that it's at the lower end of the range. And I tell folks, if it's in this lower half, that's a buy zone. And if it's in the upper half, that's the sell zone. Okay, you can do it that easy. You can even just eyeball that part, right? But if you want to really dig into how this math is figured, basically we want to figure where we are currently off of the bottom. So you take the current IV, implied volatility, minus the low to find out where the current is off of the low, and you divide that by the sum of the high, implied volatility, minus the low volatility, right? And we can get all those points. It doesn't have to be exact, folks. It's just pretty much a ballpark, right? A wag, if you will. So the current is, let's call this the current 55. I'm going to call this low, or sorry, 55 here, 55. The low is 54. And this high mark, I'm going to say is somewhere right around 77 because I'm a little bit low on that, on my line there. So what do we have? We have the current 55 minus 54, right? Current minus the low. And then take that sum and divide it by the high, which we said was 77, minus the low, which is 54. So I've got 1 divided by 23 please check my math if I'm messing this up. And this should give us somewhere around, it's 4.34%. So anyway, a lower end, below 50 buy, above 50 is sell. Right now, we're well below this number. Now, when I was talking about, you know, in these pop or drop videos, remember we started out a little bit closer with the butterflies. Those butterflies had volatility percents right around 30, if you remember. And I was telling you, those you kind of need a little bit higher volatility for those butterflies on the pop or drops, okay? Then we talked about the strangle. Had a little bit higher volatility there. This is extremely low. I mean, anything single digits is something that I just know is super cheap. So that's allowing me to be a little bit more aggressive and go from the strangle to the straddle. All right, so I'm looking for the straddle right now since my volatility is so low. All right. And I have the expectation volatility is going to expand. I will explain that a little bit further here. Actually, you know what? I will here real quick if I can go back to this. So we've got this volatility that's really low. Now, one thing we know on earnings, look at the earnings there. We can see the volatility spike, an earnings volatility spike, an earnings volatility spike, right? Because anytime we go into an unknown, volatility spikes because of that unknown. Anytime there is, you know, angst about something, that is where you're going to see that volatility spike. So with this volatility really low and I've got this earnings coming up, I would expect this volatility to rise, right? I know they're cheap right now, so it's leaning me towards buying. Well, and also if I'm heading into an earnings, volatility's got to spike. It always does. So that's what I'm looking for in this trade. All right, levers and pulleys going, right? Super low volatility. If volatility comes out, it's right there at its low. It's not going to come out that much. It's not going to come out at like 5 percentage points at a crack, right? It's probably going to increase at that rate at this point because we are so low. And, you know, like we were talking about with the swing trades, you know, I talked about this with this one is, you know, you can see that it is like a swing trade where you can kind of find the support and resistance. Mine are finding the extremes, but if you just kind of try to clip all the tops, you could see that volatility rarely gets above, you know, the 70s for the most part. All right, so are the options cheap or expensive? Well, we determined they're pretty cheap, right? So what does that mean? We need to be buying options, all right? One thing when we're buying options, we have to consider the thief. Remember, I told you, you can't get rid of the thief. That thief in the night is coming to steal your premiums, and it's not linear. It doesn't happen. I mean, it happens every night, but further out in time, it takes like a penny, and then it's like a nickel, a dime. The closer and closer we get to expiration. It's not like a dollar. It slowly starts increasing the closer and closer we get to expiration. So as an example here, to give you a visual, what we look at with this is we can see that for the most part, inside of 45 days to expiration is what I usually look for. 45 days to expiration and in is where you want to sell. Why? Because you can see that erosion of your premiums, right? I mean, that's just like a free fall. But out in time, and I like to sit here and go outside of 70 days to expiration, is the buy zone. All right? Because look how, I mean, you can't stop it. Like I said, you can't stop it from happening, but I can limit how much he takes by getting further out in time. All right? So I like to get outside of 70 days on the buys, inside of 45 days on those sell zones. All right? So, and the reason why is because of this massive theta drop. And if we go into real life examples here, we can see what happens. If you're looking out even further than that, where I was talking 70 days to expiration, on this example here, I'm looking at 128 days, right? So if we're looking at 128 days here, and I look at it going in 30 days, what happens to the theta in this column, right? Here's the theta column for the calls and the theta column for the puts. So you can look at both sides of them, right? The calls and the puts for the theta. It's always negative. But out here in time, we rally in 30 days. We only see it increase by 1 penny here. Now let's go in another, actually, I want to look at from 30 days, where we go from 30 days to 0 days. That's inside that 35 days to expiration. Look how much theta starts increasing. Now it goes like, might be 11 cents here, 12 cents here, 25 cents here, 30 cents here, the closer and closer we're getting. And then it'll get up to like 45 cents at night. That's what we're looking for. Limit that theta decay by going further out in time, and try and get into a situation where we can hold on to that cash. All right, so let's take a look at our one that I'm looking at for Penn, because I think there's going to be a pop or drop scenario. Again, if we're outside of that 70 days to expiration, let's see what happens over the next 30 days on the theta column, right? So on the theta column here, we can see that we go from 80 days here to 50 days, right? And I can see that my theta in this column is what I want to look at, goes from 4 cents a night to maybe 6 cents a night. So it increased to 2 cents, right? But let's look at from 50 days to 23 days. That's another 30 days. It's gone from 6 cents to 9 cents. So, percentage-wise, that's a pretty big difference. And then if you had gotten inside of that 35 days there, look what happens if you had to hold on to this trade going in there. I mean, that's crazy erosion of your premium. So get out in time in order to increase your probabilities there, because your probabilities are going to massively drop if theta's eroding away at your premiums, right? You're never going to be able to make up for that very easy. All right, so we're looking at the long straddle because I got this pop or drop. They're super cheap, and I don't know what direction it's going to go. So delta is something I left off of when we were talking about those options, right? And that's because I knew this was coming up. So delta tells us the rate of change to our options premium in relation to the underlying. So what that means is, as the underlying goes up by $1, XYZ, right? Go back to that example. It goes up by $1, then all of my options will adjust according to that delta. The puts are negative, the calls are positive. So if it's like a 30 delta, the underlying goes up by $1. What does my premiums and my options go up by? The delta, 30 cents. All right. So it's the rate of change. But I want you guys to take away that this is just data, right? That's all we're really talking about here with delta. And it tells us a couple of things. It tells us our probabilities of being in the money. Probability of being in the money. All right, probability of being in the money. So if I have a 16 delta option, it says during the life of that option, you have a 16% chance of it finishing in the money at expiration by 1 penny. All right. So in that one example where I was talking about the 105 calls, if that was like a 30 delta, that's telling me that I have a 30% chance of being 1 penny in the money at expiration. That's 105.01. All right. So 1 penny in the money. That's your probabilities. Probability of touch, though, is a floor trader hack, and that's 2 times the delta is your probability of touch, which means during the life of this option, 2 times that delta is your probability that you will see that strike price trade. All right. Whether it goes up there and hits it one time for a 1 lot high ball or whatever, that's your probabilities. 2 times probabilities are the probability of touch during the life of this trade. And what it's going to also tell you is your, what was I going to say? This is wrong. The 2 times the probability of touch is really what I wanted to go with. 2 times the delta equals your probability of touch. Just meaning comes up there and hits it. All right. I'd rather look at delta for the probabilities than how it's adjusting my premiums. So that's what I'm taking away from that. All right. So with this one, XYZ is trading right here. Believe it or not, what we're going to try and do is nail it right there. And we're going to sell a call in what? I got the white. I want to sell a call. Or sorry, I want to buy a call and buy a put right there at the 50 delta. The puts are going to be a negative 50 delta. The calls are going to be a positive 50 delta because the puts are negative, right? So I'm going to, if I'm buying both of those, if the puts go in the money, I make money that way, right? Because a negative move plus a negative delta makes that a positive to the strategy. I will lose money on the calls in that regard. But if the underlying moves higher, my calls will increase and my puts will decrease. Now, I'm looking for big moves here to happen and that volatility to increase, because if volatility starts just going up, even if I'm directionally wrong, it could offset. I mean, I showed you that in some other examples, right? If volatility increased 5 percentage points and the underlying only moved by $1, my volatility is probably offsetting any any incorrect moves from my assumption. All right. So basically, we're going to try and encompass any direction, any move whatsoever, dollar up, dollar down. I don't care. I'm just trying to capture every move possible. And so for the long straddle, like I said, we're going to be looking right there at buying. This is an at the money. Sorry. I'm going to go back there and change this quickly so that nobody messes this up, because folks, actually one is going to be out of the money and one is going to be in the money most of the times. But the ones that are very close to where we are currently trading are considered to be the at the monies. All right. That's the ones that are just right there where the underlying is trading. So these would be considered at the monies on that. Why are they at the monies? Because we can say 74.19. What's the closest one to that? 75, right? That's the closest one. Sometimes, folks, you aren't going to get it as close as this one, right? Sometimes it could be, $77.75 or something like that. And it's going to be an iffy one. But another thing is, you can also see I'm not able to get a negative 50 delta and a negative positive delta that I talked about. That's a very rare occasion. Will almost never, ever, ever happen. All right. So just know we're going to be trying to pick those at the monies. One might be slightly in the money. One might be slightly out of the money, but those are the at the monies. Okay. So hopefully not confusing anybody. So when I basically buy the call, I'm buying this one and I'm buying this one. You add those two premiums together. All right. $14.90 per one lot. All right. Now remember, you have an option contract multiplier. You got to multiply this by 100. So ultimately, I would have to pay $1,490 plus commissions. All right. So if this is a little bit steep on premiums, look at something else in this space. Maybe if you're looking for these casinos to pop or drop, this is a little bit of a different beast, but that would be the scenario. Okay. Same thing for like a Marathon versus a ConocoPhillips versus, Exxon or something. Any of those are going to have different prices. Just try and find the one that will fit your budget, I guess. So $14.90 is where we are looking at. Now, what does that mean? $14.90. Well, I have to add that into the calls. That's my break even to the upside. All right. I have to make up that difference at my expiration. Okay. If this happens tomorrow, if this thing starts making a move tomorrow, then I'm going to become profitable much quicker. All right. This is considered at expiration, meaning the very last day, all options that are out of the money are going to expire worthless. All right. So in that, I would have to make up, because I paid a debit, I have to make up that difference. So it has to be a very big outpaced move. So you need to have that happen, or it starts moving quickly. Now this purple line shows that volatility is right here at the time of inception, but I see volatility start increasing. You would see this purple line do that. Jack higher, meaning you're already profitable. The price of the underlying might not have changed at all. If you just see volatility increasing, those premiums are increasing. You could get out of this right now just on the volatility pumping up, right? Because I bought it here, we know that for every percentage point increase in volatility, my premiums are increasing by that corresponding coefficient in the option montage. And we're going to see this price increase as well. Therefore, we could sell it out without the underlying trading and have a profit, okay? Vice versa, if you would have gotten involved in this trade with really high volatility and that volatility started coming out, or got involved in this on earnings, you would get crushed on that volatility crash, all right? Well, we used to call it volatility crush. And if you bought premiums when volatility was high, you got crushed. All right, so we know the break or the risk reward. Where do we get out? On this one, I would say get out on a loss. I almost started trying to write. So for a loss, I would say 50% of the debit. All right. So in this case, I was looking at like 14, let's just say 1450. All right. Then I would be getting out if it was only trading around $7.25. That would be my out on a loss. Okay. On a winner, I'm going to be looking for it to increase by that 50%. All right. So then we're looking at $21 and what? Brain dead. 21. Is that 75? 21. 25, something like that. Anyway, it's been a long day of math, I guess. So anyway, so 50% reduction in my premium or that 50% gain. All right. That's all I got, folks. I guess I'm at the end here. Before you go, though, make sure you subscribe and hit the bell. Like the video. Appreciate that. It really does help out. So please smash that like button for me. Feed those friggin' bots. Get them out there. And for that, I'm going to give you guys this offer here, which is for our members here. So basically, you're going to get all kinds of hours of content here. It says 15 hours. It's well over that. I think there's over 20 videos, and you guys know me. I really can't go very long without really running long on anything. For that, I'm trying to get this thing to work and it doesn't want to. So with that said, I do have a tendency to run a little long because I want to make sure you folks are clear of concepts. So although I might say they're an hour long, this one's already an hour and this was a quick one. So I've thrown the link over there on the side so you guys can hit that as a hot link, but over 15 hours of trading. Somebody recently just asked me about the market profile here. I have videos on this as well. I talk about it in my spotting the trade videos. It's one of the more important things that I look for in a trade. I appreciate you, Jeff. I appreciate you a lot. Thank you. But for 36 bucks, that's a good deal. You know, like I said, it's a 36-cent option plus the multiplier. But here's a little bit more of what you get. You can learn to set up your screen like I do. You can get that script for free, all of that stuff. Also, the rising interest rates. Who hasn't heard about rising interest rates anytime recently? Listen, folks, if you guys haven't paid attention to your bond portfolio, this could be very painful next couple of years. I showed somebody, we've been at lower interest rates. This means 30-day, your overnight Fed fund rate is 0.25. This is about 10 years old. This is a trading ticket from 10 years old from the floor. All right. I don't know what you guys think. Anybody know where Fed fund futures are right now? Yeah, 0.25. So nobody's had to worry about this for over 10 years. And folks have got tons of bonds in their portfolio at these low friggin' interest rates. As interest rates rise, who do you think wants a 1% coupon when we're trading 5% coupons? Zero. And those bond prices are going to tank. Yes, if you hold it to the end of time, you will get back par value. Average person holds it for 7 years. That is a painful learning lesson. So I show you how to protect yourself in that. I mean, for that alone, it's worth the price of admission, folks. Take advantage of it. And that's all I got for you guys. Here again is the link. And if you want, you can see that we have the phone number right there. Reach out to us at 310-598-6677. If you have anybody, a couple of things we're going to be doing. I'm going to be doing some interviews with some folks. If you guys have folks you want me to interview, throw it down in the comment section. I'd be happy to come back and check those folks out and talk to them. Or email us a name at trading@protraderstrategies.com. I'm reaching out to all kinds of folks. We're trying to get them lined up. People I know that are good traders, and I'm sure you do too. Primo's one of them. He's going to be my first guy on the list to talk to about how he trades and what his daily operations are like. But reach out to us, 310-598-6677, or email us, those folks, at trading@protraderstrategies.com. All right, that's all I got for you guys. I do really appreciate you all sticking around and commenting, all of those things, smashing that like button, hitting the subscribe. And if you can't take that, take it easy. That wasn't a very good one. That was better. I think I marked it up. Bye for now.